Hey there, Prof. Aram here, and in this series of videos, we're going to look at the history of the capital markets and draw some lessons and conclusions when we look at the historical data, the events that happened in the past in the capital markets. And hopefully that will lead us to understand our investments better. So let's get to it. Looking back through time, we know that first of all, there is a reward for bearing the risk. There's a return for bearing the risk. And the greater the risk, the greater the potential return for that investment. So far, we didn't say much about what determines the rate of return or required rate of return on an investment. The simple answer is that your return depends on the risk of the investment. The higher the risk, the higher the potential return. And we call this risk return trade-off. But this raises a more interesting / difficult question, which is how can we measure the amount of risk inherent in an investment? So now we're focusing on this one. Or what do we mean when we say one investment is riskier than another? So the obvious first step here is to define what do we mean by risk and what do we mean by return. And the goal of these series of videos that you're going to see is to find out what the capital market history can teach us about risk and return. And we want to get a feel for the numbers. What is for example, low rate of return or a high rate of return? Or what return should we expect from financial assets? Or what are the risks of these financial assets? So we are going to start our discussion by defining what return is. We can do it two ways. One is by defining the dollar return, and the other one is the percentage return. So the dollar return is nothing but the amount of dollars that you receive from an investment. And there are two ways to receive that dollar from an investment. One is through the income from the investment. The other one is through the capital gain or loss due to change in the price. So if you own a stock, for example, the income would be the dividend you receive from the stock. Or if you own a bond, the income would be the coupon interest rates you receive from the bond. And the capital gain and loss is basically the change in the price. If the price goes up, you will have a capital gain. And if the price goes down from the time that you purchase the asset, you will have a capital loss. So as an example, say you bought a bond for $950 a year ago, and you've received two coupon payments, $30 each from this bond, and then you're going to sell it today for $975. What is the total dollar return? Of course, it's the income from the instrument, which is $60, plus the capital gain, ending price minus beginning price, $25. So overall, you have $85 in total dollar returns from this investment. So again, there's an income component and there's a price component. But some of you might think that the capital gain or loss, you're not going to realize it unless you sell it. But that's only for the tax purposes. Whenever you want to calculate the return on your stock or your bond, regardless of whether you sell it or not, you need to include the capital gain or loss since the time you purchased the asset. Again, some people may think that I haven't sold this stock yet and the price is down 20% since I bought it. But since I haven't sold it, there is no capital loss here. But again, that's for tax purposes. When you want to calculate the rate of return of your investment so far, you need to include the capital gain or loss. The other way you can define returns are in percentage terms, percentage rate of return. It is generally more intuitive to think about returns in percentages rather than dollar terms, especially if you have investments of different size. Of course, the dollar returns are going to be different, but the goal here is to find the rate of return per dollar of invested capital. All we're doing here is this is the income that we had before, and this is the capital gain or loss. All we're doing is dividing the income or capital gain or loss by the beginning price, by price at time 0. So let's say for a stock, the total percentage rate of return is your dividend yield, which is the dividend over price today, plus the capital gain yield, which is price at the end minus price today over price today. Basically, to find the capital gain or loss, we do ending minus beginning divided by beginning, or ending divided by beginning minus 1. So that gives you the total rate of return in terms of capital gain or loss. And then the income component is the dividend yield. I hope you find this video useful, and thanks for watching.